What's up, YouTube? We're going to go over Autodesk, ticker ADSK. They just reported their earnings yesterday after the market close. And after earnings, currently today, we're noon on the trading day, my time, or actually 1 o'clock. Um, Currently trading, up 2.6% after earnings. Year to date, up 13.3%. And after over the course of 1 year, 1.8% down. Um, Earnings were announced yesterday. They beat on top and bottom lines, which is probably why the stock is moving up. Overall, in their press release here, nothing too surprising, nothing bad, nothing good. Just kind of seems like they're just floating along. Over here, I want to point out real quick. So this company's been around since like 1986. And it, for a company that's been around for that long, they're only doing like $4.7 billion in annual revenue currently, as of really just recently. They're making, they're hitting new records for themselves with revenue. And on top of it, they're not really that profitable. And you'll see that soon on the free cash flows that they're barely, they're not making a lot of money. And for a company that's so established, it's kind of surprising. So anyway, we'll come over here. Peter Lynch valuation. We got our ticker entered in. We have our future EPS growth rate of 13.47. There's no dividend. 10.3% growth on revenue forward. Our PEG ratio as of today is 5.02. Our forward PEG is 2.4. Both are substantially overvalued. We had only two multiples that we could compare to that were actually profitable companies. That gives us a price based on comps of $130 per share. Graham's valuation over here, we have our growth rate projection of our EPS of 13.47. Current yield on AAA corporate bonds is 5.16. Come down here to the manual PE. We got market cap basically $45 billion. Cash equivalents only $2 billion on the balance sheet, $7.5 billion on debt, and cash from operations annually of $1.7 billion, which a multiple of 30 years. Return on invested capital is pretty good, 25.3%. And then price to book ratio, again, for a company that's so established, it's not even a positive price to book ratio. Let's come over to the DCF. Typed in all the information for the weighted average credit cost. Um, oops, let me redo that. And then we got all this in here. We get a weighted average credit of 9.7. Comes over here. We got a perpetual growth rate of 2.5%. Growth rate of free cash flow I put in for 4%. The analyst growth rate is 4%. Average growth rate it's all over because they up until really 2019 they weren't really producing much free cash flow. In 2018 they're actually negative. If I put a negative number in there, it messes everything else up in terms of growth here. So come down here. Got a sum of future free cash flow of 21 billion, cash and securities 2 billion, 7.5 billion in debt. Shares outstanding 215 million shares with a discounted cash flow price of $73 per share. Over here at Rule 72, our current EPS is 4 and our growth rate is 13.47. 13.47 goes into 72 5 times. 5 goes into 10 because it's 5.3. It goes into 10 just shy of 2 times. So I used 2. So I put 16 in for our future earnings per share. And that gives us a fair market value today of $108 a share, purchase price of 30% margin of safety of $75.43. So you come over here a little bit. We got all of our values entered in over here from all the other valuations we did. Gives us an average price of $88 with 30% margin of safety, we're looking at a $62 per share buy price. And a real quick summary of the company overall is the balance sheet's really weak. There's nothing to be too excited about on growth or cash flows, even anything. It's clearly significantly overpriced. Uh, did the debt is growing quicker than the cash on the balance sheet, which sometimes is not a bad thing, but when you're not making that much money, it's not ideal. The few good things here is the revs are growing faster than the operating expenses, so that's a bonus. They are producing free cash flow, and the Q3 guidance they gave, for next quarter was just in line and just above what estimates or what analysts had expected. So we'll pop over here to the stock chart, and so like I said, this company's been trading since, let's see here, 1985, and really only as of and since 2017 did this company begin to actually start showing some interest to investors. Now we have this trend line from 2016 when the hype began, the interest, and right now we're sitting on this trend line. Depending on where you want to draw this trend line, and I feel like this works out pretty good. It ties in a lot of different areas with this, where it's traded previously. And then we've also got this macro trend line too here that's showing us a wedge. Now this wedge for a breakout could or break down. Obviously, we could rest here for another month or 3, 4 months till the end of the year, and we either go this way or we go that way. I think it can go either way. I honestly, just based on technicals, but based if you tie in fundamentals, I believe we're going to go like this, and then we're going to go like this because the fundamentals don't line up with the technicals whatsoever. It shows that this company is very overvalued. Maybe they can grow into their valuation and then they're soon worth $200 a share, in the future. But right now, the future outlook does not appear to be that way. The growth rate is just a low mid-teens grower. We're not talking 30-40% growth, you know, and we're trading over double what the current, valuation is currently. So that's my take on Autodesk. Let me know what your guys' take is on Autodesk, what you're going to do with Autodesk, if you're buying, if you're selling, if you're just going to stay away. And also, if you wouldn't mind liking and subscribing the video if you found value in it. But that is it for this one. We will be back later with more.